Are ICT or smart money concepts truly effective? Have you ever watched trading strategy videos, particularly those focused on ICT, inner circle trader, or so-called smart money concepts? Many such techniques claim to use institutional-level trading strategies, promising consistently high win rates, with some elements appearing quite reasonable at first glance. However, when applied to real-world charts, they often fall short of the promised precision. In our team's journey to learn and analyze these techniques, we identified some intriguing points. So, are these concepts completely useless, or do they excel under certain specific conditions? In this video, we'll explore this topic together and dive into the truth behind these trading methodologies. The smart money concept in practice. Let's start with a classic smart money scenario. Price breaks below a key low, purportedly to grab liquidity, and then quickly rallies to hit a target, locking in profits. Proponents of SMC often explain this as the market moving from one liquidity pool to another. They argue that institutional traders manipulate price to trigger retail traders' stop-loss orders, accumulating positions before pushing prices higher. However, this reasoning doesn't inherently reflect the fundamental principles of how markets operate. Instead, it frames a market behavior that can be explained by more conventional means, using terms that sensationalize its nature. A traditional interpretation. Revisiting the same scenario, let's use a traditional support and resistance framework. The price drops to a support zone, rebounds, and breaches resistance, which then turns into support. Upon retesting this support, the price forms a textbook Morningstar candlestick pattern. A trader enters at market, sets a take-profit level at the next resistance, and watches as the price swiftly hits the target. This comparison reveals that both SMC and traditional technical analysis often identify similar entry and exit points. The difference lies primarily in terminology. Liquidity grabs and false breakouts are essentially describing the same phenomenon: market reactions to imbalances in supply and demand. To quote Mark Twain, "History doesn't repeat itself, but it often rhymes." SMC repackages classic concepts, adding a layer of mystique by invoking institutions and large players. Comparing FVG and Fibonacci, now consider a price move utilizing the fair value gap fair VG from ICT methodology. The price retraces into this gap and resumes its trend upward. Proponents might argue that this validates FVG as a precise tool for identifying high probability setups. But applying a Fibonacci retracement tool tells a similar story. The price reacts at the 50% level, a common turning point. This observation reinforces the idea that these tools often overlap in their practical use, with the effectiveness stemming from the trader's skill in identifying key zones rather than the specific framework employed. Why is the smart money concept so popular, even if it might not be as effective as claimed? We're not denying its effectiveness, but first, let's clarify that we are not outright denying the potential effectiveness of the smart money concept, SMC. However, after watching several of the educational videos promoting this method, a noticeable pattern emerges. These videos tend to heavily leverage emotional appeals to influence the judgments of retail traders. For instance, they often create a narrative dichotomy between the smart money, institutions, and dumb money, retail traders. This framing fosters a sense of exclusivity and superiority, leading retail traders to aspire to outsmart others in the market. One of the most common claims made in these videos is that institutions are deliberately targeting retail traders' stop losses before driving the price in the opposite direction. While this might happen in isolated cases, in the real world, institutional trading decisions are rarely, if ever, influenced by retail traders. Large institutions operate with broader objectives: hedging, portfolio balancing, and capturing significant market trends where the actions of small-scale retail traders play a minimal role. Therefore, constructing a trading strategy based on the assumption that retail stop hunting is a priority for institutions is speculative at best and lacks substantial evidence. Selective examples and the illusion of high win rates. Another tactic often observed in these SMC teachings is the selective use of trading examples. They frequently highlight trades with risk-reward ratios of 301 or 401, portraying this as a hallmark of a high win rate strategy. In addition, they showcase impressive profit figures, often amounting to thousands of dollars, creating the impression that these outcomes are typical or easily achievable. However, this selective presentation does not tell the whole story. A mature and disciplined trader understands the importance of evaluating a trading system's performance over an extended period, considering both winning and losing trades. It is not enough to cherry-pick a few successful trades. What matters is how the system performs consistently across various market conditions over time. Interestingly, these educators rarely disclose the actual long-term win rates or profitability metrics of the strategies they teach. This omission is telling. They likely know that extensive backtesting might reveal less impressive results, which could deter potential followers. The emphasis on recent visually appealing successes creates a cognitive bias where viewers overestimate the strategy's reliability while underestimating the inherent risks and potential inconsistencies. Why it remains popular despite its flaws. The enduring popularity of the smart money concept can be attributed to its psychological appeal. By promising an insider's perspective on how the market really works, it caters to the common desire among retail traders to gain an edge over the competition. The narrative of smart versus dumb money is both engaging and empowering, offering a sense of control in an otherwise unpredictable market. Additionally, the allure of high profits, simplified by carefully curated examples, provides a quick fix solution that many aspiring traders find irresistible. In conclusion, while the smart money concept might have some practical elements, it is crucial to approach it with skepticism and a focus on evidence-based practices. A successful trading strategy requires rigorous testing, long-term evaluation, and a solid understanding of market mechanics, while the fourth model, qualities, that are often overshadowed by the emotional appeal and selective presentation found in many SMC teachings. Conclusion: through our analysis, you might question the validity of ICT and smart money concepts. While they aren't inherently ineffective, they often restate existing principles using more complex terminology. The key takeaway is that most traders, regardless of the system, focus on critical price levels. The names or explanations behind these levels are secondary. This video marks the beginning of our channel's journey, where we distill insights from traders around the world, sharing practical techniques and avoiding common pitfalls. In our next video, we'll unveil a simple, effective, and profitable intraday strategy that doesn't require constant monitoring and has helped many traders achieve success. If that sounds exciting, subscribe and like this video. Your support enables us to create more high-quality content and trading systems. Let us know your thoughts in the comments, and see you next time.